Welcome to Infinity Learning Space, and in this video we are going to learn source documents and books of prime entry. Right. So in our previous video we learned that a business is any activity engaged in producing goods and services. And for a business to produce goods and services, the business needs to enter into numerous transactions. For example, we looked at a wooden furniture manufacturer. A wooden furniture manufacturer has to buy wood, has to buy paint, has to buy nails, then has to hire workers to make the furniture, then also has to sell the furniture to customers. So all those things are different transactions that wooden furniture manufacturer enters into. And all those transactions need to be recorded, analyzed and summarized. And that's what accounting is about. So accounting is about recording, analyzing and summarizing different transactions entered into by a business. Right. Now at the end of our accounting process, we learned in our last video what we want to come up with is the set of financial statements like the income statement, the balance sheets, the statement of cash flows and so on. Right. So at the end of the accounting process, we want financial statements. But the thing is, financial statements is not something you can come up with or something you can make all of a sudden, right? You can't just record a transaction and all of a sudden make the financial statements, right? To make the financial statements, from the point of entering into a transaction, we have to go through a series of steps, right? To finally arrive at the financial statements. So when a transaction is recorded, it has to go through a couple of steps to finally prepare the financial statements. A business has to follow these steps in the accounting process to finally prepare the financial statements, normally at the end of the year. Right. So in this video, we are going to focus on the first two steps of the accounting process. You can think of this as the accounting process. This is what accounting does. And in this video, we are going to look at the first two parts of this accounting process: source documents and books of prime entry. Then after books of prime entry, we will have to record the transactions in ledger accounts. From the ledger accounts, we will prepare the trial balance. And from the trial balance, finally, we will prepare the financial statements. Right. So today we are going to focus on these two first steps. Okay. So let's first look at source documents. And to understand source documents, let's go back to our wooden furniture manufacturer example. Right. So that wooden furniture manufacturer has to buy wood, paint, nails, then has to hire workers and pay them salaries. And once the furniture is manufactured, has to sell them to customers. So buying paint and wood, making a payment for paint and wood, then paying salaries to employees and finally selling the products to customers are all transactions entered into by that business. Now, when we buy wood, when that business buys wood, paint and nails, right, the business will get an invoice from the supplier. Normally, we call it a purchase invoice. We know when we buy goods from any shop, we will get a small document, a small sheet called the purchase invoice. In most businesses, we will get a purchase invoice, right? Then, when the business pays salaries to the employees, a payment voucher will be released, right? The business will give a check to the employee or will do a bank transfer to the employee's bank account, and along with that there will be a payment voucher, a salary slip, some sort of document. Then finally, when the business sells goods to the customer, the business itself will issue an invoice. Now when the business bought goods, it got an invoice from the supplier. We call that a purchase invoice. When the business sells goods, it will issue an invoice to the customer called the sales invoice. So this purchase invoice, the payment voucher and the sales invoice are all what we call source documents. Those are documents that give us evidence about transactions entered into by a business. Without those documents, we can't really be sure that a business entered into a transaction. So those documents, the purchase invoice, the payment voucher, sales invoice and many more documents give us evidence or proof that a business entered into those transactions. Right. So that's our first step. All transactions entered into a business is first recorded on documents called source documents. that is evidence or proof that a business entered into a transaction. So through the purchase invoice, we know that the business purchased wood at a particular price, and this is how much the business should have paid or paid. These give us evidence of transactions that took place with details of the transaction, right? So if you take the sales invoice, right, the sales invoice is evidence or proof that goods were sold to a customer. That is evidence. Then it also gives us details of the transaction, because in the sales invoice it will tell you how many goods were sold at what price per unit, and then what is the total price charged from the customer. So it gives us evidence that a transaction happened, the sale happened, and also tells us information about that transaction, right? There are different kinds of source documents depending on the type of transaction, right? So for different types of transactions, there will be different source documents. We will go through a list of source documents next, right? So different types of transactions will have different source documents. A small difference can also be identified between source documents and supporting documents, right? So along with source documents, we will also look at something called supporting documents, right? So now the difference between source documents and supporting documents is that source documents is actual evidence or proof that a transaction happened, right? Whereas supporting documents give us details about a transaction but is not actually direct evidence that a transaction happened. But most of the time we use source documents and supporting documents together interchangeably, right? When we say supporting documents, source documents, most of the time we mean the same thing. But there's a small difference. These give us direct evidence that a transaction happened. So this will include items like the purchase invoice, sales invoice, debit note, credit note, receipt, right? Payment advice, things like that. Whereas supporting documents are documents that give us information about the transactions, but it doesn't give us direct proof that a transaction actually took place. So this includes things like quotations, purchase orders, goods received note, and so on, right? So now don't worry too much about it. Like I said, most of the time we use both of them together. Okay, so first we are going to look at supporting documents beginning with quotations, right? Now let's say a business wants to buy some goods, right? The business wants to buy some goods. So let's take the same example, the wooden furniture manufacturer. Let's say that business wants to buy some wood, right? Okay, so the first thing the business has to do is ask potential suppliers to send the business a quotation. Now the business wants to buy wood, and the first thing the business is going to do is not place a purchase order directly with a supplier, but look around and see who can supply wood. And once the business identifies different suppliers for wood, the business will ask those suppliers to send a document called the quotation explaining the quantity of wood that they can supply, the price of the wood that they are going to charge, right, and other terms and conditions, right. So a quotation is simply a document sent to a customer by a supplier stating the price, quantity, and other details related to goods or services. So all the potential suppliers will say, okay, this is how much I can supply, this is the type of wood I can supply, kumbuk, mahogany, or whatever, and this is the price I'm going to charge you, right? It's a document that tells us, okay, this is what I can buy from this particular supplier at this price, and these are the terms and conditions, right? So quotations tend to be used when business do not have a standard listing of prices for products. For example, when the time, materials, and skills required for each job vary according to customer needs. Now, quotations are not used all the time. Quotations are normally used when the price, material, the terms and conditions differ from one order to another, right? Most businesses do not give quotation. What they have is a list of prices. Now, if you go to a restaurant, they don't give you a quotation, right? They will tell you, they will give you a menu, they will give you a list of prices. Even if you go to a grocery store, right, you get a list of prices. You are not going to get a quotation. So a quotation is most of the time used in situations where from product to product, right, from job to job, the prices, terms and conditions can differ, right. Quotations can't be changed once they have been accepted by the customer. So the supplier sent the quotations to the customer, and then by looking at the quotations, the customer will pick the best supplier here, the supplier that offers the best terms and conditions, the best price, and who can supply the quantity required by the customer. So once the customer accepts the quotation, the supplier cannot change it later on. Then now the customer goes through the quotations and picks the best supplier, and once the best supplier is picked, the customer has to formally communicate to the supplier, to that selected supplier, that he wants a particular amount of a good at this particular price, right? So once the customer has decided who the supplier is going to be, the customer has to send a formal document to the supplier saying, okay, I have selected you, I want you to supply this quantity of this good at this price that you already agreed to through the quotation. So that document is what we call the purchase order. It's an order sent by the customer to the supplier, formally requesting the supplier to supply goods. A document sent by a business ordering goods or services from a supplier. It will contain details of the goods, services required, quantity, terms and conditions, etc. So the purchase order will tell how much of the particular good to supply, what goods to supply, then other terms and conditions like where they should be delivered, when they should be supplied, the quality of the goods, the color of the goods, things like that. Normally 2 copies of the purchase order will be created, right? So when the customer prepares the purchase order, 2 copies will be prepared. One will be sent to the supplier, that's the formal request to the supplier saying, I want you to supply these goods. And the other one will be retained or will be kept by the customer himself to check with later documents, right? And purchase orders are normally sequentially numbered. What that means is when a business issues purchase orders, they will be numbered in the order they were issued. So the first purchase order will be numbered 1. The second purchase order issued by a business will be numbered 2. The third purchase order issued by the business will have the number 3. The fourth purchase order will have the number 4. So on, right? So that's what sequentially numbered means, right? So then we have the sales order. Now once the purchase order is sent by the customer to the supplier, based on that purchase order, the supplier will create a sales order, right? So the sales order will normally have the same information the purchase order has. The document prepared by the supplier with details of an order placed by a customer for goods or services. Now remember, the purchase order is prepared by the customer, the sales order is prepared by the supplier. The customer may have sent a purchase order to the supplier from which the supplier will then generate a sales order, right? Sales orders are usually sequentially numbered so that the supplier can keep track of orders placed by customers. So similar to the purchase order, even the sales orders will have a sequential number, right? So the first sales order will have the number 1, second sales order will have number 2, and so on. So why does a supplier prepare a sales order? A supplier prepares a sales order because different customers can send purchase orders in different formats, in different documents, via email, via mail, right? So the orders received from different customers can be in different formats. So it's difficult for the supplier to process all those documents that are prepared in different formats. It's easier if the supplier can transfer all those information into a format, into a document that he is familiar with, right? So when the supplier receives orders from different customers, the information in those different orders will be transferred or copied to a format, into a document that the supplier can easily process, that the supplier can easily understand. So that's why normally a sales order will be prepared, right? So once the sales order is received, what will happen is the supplier will start manufacturing the goods, or if the goods have already been manufactured, the supplier will start loading the goods onto a truck or some delivery vehicle, right? Now with the delivery vehicle, with the goods, right, the supplier will send a document called the goods dispatch note, right? So with the goods, with the delivery truck carrying the goods, the supplier sends a document called the goods dispatch note. In the goods dispatch note, we get the details of the goods dispatched. Dispatch means sent, right? Dispatch means sent by the supplier along with the goods, right? So with the goods, the supplier sends a document that tells, okay, in this delivery truck, these are the goods that I am delivering to you, right? It's a document sent to the customer. So when the customer gets the delivery truck, the customer can check the goods dispatch note with the actual goods delivered, right? Check whether the delivery note has the goods the goods in the delivery truck, and whether all the goods in the goods dispatch note are actually in the delivery truck, right? Now sometimes what can happen is the supplier can load the goods to the delivery truck, right? But on its way to the customer, the delivery truck driver can stop the truck and steal some of the goods. But if the supplier sends a goods dispatch note, then when the customer gets the good, the customer can check the actual goods in the truck against the goods dispatch note and identify any difference. So if the supplier has said, I have sent you 1000 kilograms of rice, the customer can check whether actually 1000 kilograms of rice have been delivered. If not, he can contact the supplier and say there is a difference between your goods dispatch note and what is actually delivered. The supplier will keep a record of goods dispatch note in case of any queries by customer about the goods sent. So the supplier will also keep a record of the goods dispatch note so that he is also aware about what was delivered to the customer. The customer will compare the goods dispatch note to what they receive. So like I said, the customer will compare the goods dispatch notes to the actual goods received by the customer to make sure all the items listed have been delivered and are the right specification. So in addition to the quantity, the customer will also check whether the goods delivered match the quality, the color, the design, shape requested by the customer and what's mentioned in the goods dispatch note. Right. Now, goods dispatch note is a document sent by the supplier with the goods. Then once the goods are received by the customer himself will prepare a note called the goods received note. So it's a document prepared by the customer listing down all the goods received by the customer. Now, goods dispatch note is prepared by the supplier, but the customer wants to prepare his own document called the goods received note. A document prepared by the customer receiving the goods with details of the goods received, usually prepared by the customer's warehouse goods receiving area. So when the goods are delivered to the customer's warehouse, the person in charge of the warehouse manager will take a document and will write on that the goods actually received by the customer. Often the accounts department will want to see the relevant goods received note GRN and the matching purchase order before paying a supplier's invoice. So the customer's accounts department will check the goods received note, what was actually received, against the purchase order, what was ordered, before making a payment to the supplier. Because you can order, for example, 1000 kilograms of rice, but if you have only received 900 kilograms of rice, you have to reduce the payment, because even though we ordered 1000, we received 900. So then accordingly you have to reduce the payment done to the supplier here. So the accounts department will check, okay, how much did we actually receive, how much did we order, and based on that only they will make the payment to the supplier. Right. Then we have the actual source documents. These are documents that give us proof that a transaction actually happened. Right. First we have the invoice. So invoice is normally sent by the supplier of goods to the customer, formally requesting the customer to make a payment. Invoice is a request by the supplier to the customer to make a payment for the goods and services delivered. Issued by the supplier of goods to the buyer as request for payment. For the supplier, this is a sales invoice. To the buyer, the same document is a purchase invoice. So from the supplier's point of view, this document will be called a sales invoice, because for the supplier it's a sales, it's an invoice raised because of a sales transaction. But from the buyer's point of view, the same thing is called a purchase invoice, because from the buyer's point of view, he has purchased goods. So that's why it's called a purchase invoice. But it's the same document. The seller or the supplier will call it a sales invoice. The buyer will call it a purchase invoice. Then we have debit notes and credit notes. These are documents used when goods are returned by customers. Now we'll look at debit notes and credit notes in detail in a little bit, and even invoices we'll have a closer look in a little bit. First, let's just go through the main documents. Next we have remittance advice. Remittance advice is a document sent by a customer to a supplier to inform the supplier that invoice has been paid and which credit notes offset. So when the customer receives the invoice, the customer will make a payment, right? After the payment is done, the customer will send a document called the remittance advice telling the supplier that the payment has been made. So it's normally sent with the payment itself. So if the customer is paying by check, along with the check, the customer will also send a remittance advice, a document formally saying that this is the payment for this invoice. If the customer is paying by check, the remittance advice is sent with the check to the supplier, right? So again, it basically informs the supplier that the invoices have been paid and which credit notes offset. Now, if the customer makes a bank transfer as a payment, then with evidence of the bank transfer, the customer will send a remittance advice saying that, look here, I have made a payment for this particular invoice or these particular invoices, because one payment can be for multiple invoices. A remittance advice allows the supplier to update the relevant customer records to show which invoices have been paid and which are still outstanding. So when the remittance advice is received by the supplier, supplier knows, okay, this particular customer has paid for this invoice and this is the balance outstanding, right? Because if the customer doesn't send a remittance invoice and just transfers money, the supplier will not know who gave the money, because money will be simply credited to the supplier's account, but the supplier will not know who made that payment. So the customer has to make sure he tells the supplier formally, I made that payment, this is the transfer details, I made the transfer on this date and this payment is for this particular invoice. So that the supplier is fully aware who paid and who didn't pay, right? Then receipt. So remittance advice is sent by the customer to the supplier. Then supplier, when he receives the payment, will also issue a document to the customer formally acknowledging that he received the payment, right? So for example, the customer will send a check to the supplier, and once the check is deposited and the money has been credited to the supplier's account, supplier will send a receipt saying that, okay, I will receive the check, I have deposited it and I received the money, right? So that's evidence sent by the supplier to the customer that the payment has actually been received. Document issued by the supplier to the customer confirming that a payment has been received, right? Now, why is the receipt important? Because the customer can make a payment, right? But the supplier can refuse saying, no, I didn't receive the payment. But if the supplier has sent a receipt, that is evidence that the supplier has acknowledged that he received the payment. Then the supplier cannot come later and say, I didn't receive the payment, because he has issued a document saying he received the payment, right? Then statement. Now this is a document normally sent at the end of a month to all the customers of a supplier. So all the customers of a business will get a statement reminding the customers the details about the outstanding invoices. So if the goods have been sold on credit, right, the supplier will send the statement to all the debtors or trade accounts receivable telling them, look here, this amount is outstanding from you, you have to make the payment before this particular date. So it's like a summary of all the transactions entered into by a business with customers for which money is still outstanding, for which customers still have to make payments. A document sent out by a supplier to a customer listing the transactions with the customer, including all invoices and credit notes issued and all payments received from the customer. So in the statement it will say, these are the invoices, these are the payments we received from you, and this is what is outstanding. The statement is useful as it allows the customer to reconcile the amount that they believe they owe the supplier to the amount the supplier believes they are owed. So when the statement is received by the customer can check whether the amount in the statement matches with what they think they have to pay to the supplier, and if they don't match, the customer and the supplier can talk and figure out why there is a difference. Right. So those are the source documents. Now we are going to go back and have a closer look at invoices. Right. So like I said before, an invoice relates to a sales order or to a purchase order. What that means is the same document can be a sales invoice or a purchase invoice depending on who is looking at it. So to the supplier or to the seller, it's a sales invoice. To the buyer or to the purchaser, it's a purchase invoice. When a business sells goods or services to a customer, it sends out an invoice. So normally the business that sells the goods will have to issue the invoice, and when that happens, that invoice will be called a sales invoice to the business that issued the invoice or to the business that sold the goods. The details on the invoice should match the details of the sales order. The invoice is a request for the customer to pay what he owes. So the invoice sent by the business is a request to the customer to pay what he has to for the goods delivered to the customer. When a business buys goods or services, it receives an invoice from the supplier, right? So when the business buys goods and services, they don't issue the invoice, they get an invoice from the supplier, and that invoice is what we call the purchase invoice. So again, what the supplier calls the sales invoice, the buyer will call purchase invoice. It receives an invoice from the supplier. The details of the invoice should match the details of the purchase order. Right. Then what does an invoice show? So most invoices are numbered, right? So that the business can keep track of all the invoices it sends out. So normally invoices will have a number so that it's easy to track an invoice. Information usually shown on an invoice includes the following: name and address of the seller and the purchaser, date of the sale, when did the transaction happen, description of what is being sold, what are the goods involved, is it wood, is it paint, whether it's shoes, t-shirts, whatever, quantity and unit price, how many units of the good was sold and what's the price of a unit, details of trade discounts, if any, 10% reduction in cost if buying over 100 pairs of shoes. So sometimes the supplier will give the customer a trade discount, so those details will also be included. Total amount of the invoice including details of any value added tax. Sometimes the date by which payment is due and other terms of sale. Right. So with the invoice, the supplier will tell you have to make this payment before, let's say, the 30th of this month, and any other terms of sale. It can tell the money has to be deposited to this particular bank account, or the money has to be paid through a check, right? So there can be other terms and conditions. Now let's look at an actual invoice. So you can see the invoice has a number. So each invoice will have a unique number. Then you get the name and address of the supplier, the business who sold the goods. Then if they are VAT registered, the sales tax registration number, the VAT number, date, tax point, the date on which the transaction happened, order number, this is the sales order number, right? Then the customer's name, the customer code, right? Each customer will have a code, especially if it's a regular customer. So the customer's code, it's like a ID number for the customer. Then the description of the product, what have they sold? Dishwashers. Then that's the product code. How many dishwashers? 6. What's the price per dishwasher? 9,000. What's the total price? 54,000. So that's the net amount. Then there's a VAT amount, the invoice total, and it says terms 30 days net. So this 62,100 has to be paid within 30 days by the customer. And who will use the invoice? The invoice will be sent to the customer as a request for payment. So the supplier will send the invoice to the customer as a formal request for payment to the accounts department of the customer and supplier to match to eventual payment. So the invoice will be checked by the customer, and based on the invoice only the customer will make the payment. At the same time, the supplier will also check the invoice sent with the payment received and check whether the customer has paid the correct amount as per the invoice to the warehouse of the supplier to dispatch goods. So sometimes a payment will be done and an invoice will be raised before goods are delivered, right? So once the invoice is received by the warehouse, the supplier will dispatch the goods. Most of the time goods will be delivered and then only the invoice will be raised, but sometimes the invoice will be raised before the goods are delivered. So then the invoice will trigger the warehouse or will tell the warehouse to actually deliver the goods to the sales department of the supplier as a record of sales. So the supplier's sales department will look at the sales invoices as evidence of sales when they want to keep track of the sales done by the business, right? Then we are going to look at credit notes. Now to understand credit notes, let's look at two situations, right? First one, John Limited sent out an invoice for 20 dinner plates for which the total price is 62,100, but the accountant accidentally typed in a total of 162,100. So John Limited has overcharged the customer. So John Limited has sold 20 dinner plates to a customer. The correct price for that is 62,100. But the accountant has made a mistake and in the invoice has accidentally typed 162,100. So that's 100,000 more than the correct amount. That means John Limited has overcharged the customer. The invoice is for amount greater than the correct amount. It's overcharging the customer. In the second situation, when a customer of John Limited received goods, it found that some of the goods had been damaged. Although the customer received an invoice for the whole quantity of the goods, it has no intention of paying it because some of the goods were useless and will be returned. So John Limited has delivered some goods to a customer and along with that an invoice for the entire amount of goods. But some of those goods are damaged, so the customer is going to return those goods back to John Limited. And that also means that the customer has been given an invoice for amount greater than the correct amount. Because even though all the goods were delivered, the customer is going to return those damaged goods. So the customer doesn't have to pay for those damaged goods. So again, the customer has been overcharged. Now in situations like that, right, John Limited has to issue a negative invoice because in this example, the invoice they have issued is too much, right? Here also they have issued an invoice that is too much because some of the goods are being returned. So in those situations, John Limited has to issue a negative invoice. This negative invoice we call the credit note. Now in a normal invoice, the business is asking for money from the customer. But by issuing a negative invoice, right, the opposite, right, they are cancelling some of that mistake, right? So the negative invoice that John Limited has to issue is what we call the credit note. We don't call it a negative invoice, we call it a credit note. Credit note is issued by a seller when a customer returns goods sold or when a customer has been overcharged. So the business has sent an invoice that is greater than or that is too much compared to the correct amount. So that additional amount, that incorrect amount has to be adjusted, and it is adjusted by issuing another document called the credit note. This is done when goods are returned by the customer or when the customer has been overcharged, right? So the document issued by the supplier when customer returns goods back to him is called the credit note, right? Now suppose that one of the dishwashers supplied by Southfield is damaged. When the damaged dishwasher is returned to Southfield, it should issue a credit note to Whitehall which reverses part of the sales invoice that relates to the damaged dishwasher. Now in the previous invoice we saw that Southfield Electrical, the supplier, has sent an invoice to the customer Whitehill for 54,000 with VAT it's 62,100. But let's assume Whitehill realizes that one of these dishwashers is damaged. So Whitehill, the customer, returns the dishwasher back to Southfield. But the thing is, Southfield has billed the customer for 62,100. From this 62,100, Southfield has to remove the amount for one dishwasher because the customer has returned that dishwasher. So to do that, Southfield uses a credit note, right? So you can see the credit note. There's a credit note number, then the details of the supplier, the date, customer details, and then here it says one dishwasher, why is it being returned? Reason for credit note, delivered damage. So the customer is returning it to the supplier, and the supplier has to issue this document saying, yes, right, I know I issued a document for 62,100, but you don't have to pay that entire amount. Just deduct this 10,800 from that amount, and that's what you have to pay me because you returned a damaged good, right? Okay. So the credit note format is almost identical to the invoice. You can see this format, the credit note format, is very similar to the purchase invoice format. The only differences are it is described as a credit note, so it's called a credit note, not a purchase invoice. It has a unique sequential credit code number rather than an invoice number. We know invoices also have a number, credit notes also have a separate number. A reason for the credit note is noted at the bottom of the credit note. So you can see in the credit note, the reason for the credit note is normally mentioned. It says this is a credit note because the customer has returned a dishwasher that is damaged. To make sure that the buyers do not get invoices and credit notes mixed up, credit notes are often generated in red. So the purchase invoice and the credit notes are both sent to the buyer or to the customer to make sure the customer doesn't get confused between the two. Credit notes are normally issued in red. Right. Now, credit note is what the supplier sends to the customer when the customer returns goods or when the customer has been overcharged. Right. So then we have the debit note. Now, for the same transaction, the customer can issue a debit note. Now, we just learned that a credit note is prepared by the supplier when a customer returns goods or when the customer has been overcharged. So, in the same situation, customer can also prepare a document and send it to the supplier. That's called the debit note, right? So, now for example, if the customer realizes that some of the goods have to be returned to the supplier, customer will prepare the document called the debit note and send it to the supplier. And supplier, based on the debit note, will also prepare a document called the credit note and send it back to the customer, right? So you can think of the debit note as a request by the customer to the supplier to issue a credit note, right? So if we just draw a small diagram, right? So when the customer wants to return goods or when the customer has been overcharged,
Hello future chartered accountants. අද අපි Infinity වෙතින් ඕගොල්ලොන්ට ඕගොල්ලොන්ගේ chartered accountancy ඉනේ සැබෑ කරගන්න නව අඩිතාලමක් යොදවනවා. Right? We are planning on building up something new for you all to make sure that you achieve your chartered accountancy dream. ඕගොල්ලෝ chartered accountant කෙනෙක් වෙන path එක දන්නවද? Step number 1. ඕගොල්ලොන්ට A-level වලට minimum S3ක් හරි නැත්නම් AAT complete කරලා හරි ඕගොල්ලන්ට මේක පටන් ගන්න පුළුවන්. Step number 2. ඕගොල්ලෝ ඊට පස්සේ පටන් ගන්නවා business level කියන අධ්‍යයනය. ඒකෙදි ඕගොල්ලොන්ට කොටස් දෙකක් වැටෙනවා. එහෙනම් business level 1 සහ business level 2. මෙතනදී ඕගොල්ලන්ට business level 1 and business level 2 එකට ඕගොල්ලන්ට stages 4ක් වැටෙනවා. නැත්නම් subjects 8ක් වැටෙනවා. Step number 3 and step number 4. මේල corporate level and strategic level. මේකෙදි ඕගොල්ලන්ට corporate level වලදී subjects 4ක් තියෙනවා. ඒ වගේම strategic level එකේදීත් subjects 4ක් තියෙනවා. Step number 5. මේක තමයි ඔයාලගේ last stage එක. නැත්නම් SL5 case study එක. මෙතනදී ඔයගොල්ලන්ට පොඩි task එකක් තියෙනවා. ඒ මොකද්ද? ඕගොල්ලන්ට ඕගොල්ලෝ study කරන subject එකේ ඕගොල්ලන්ට study කරන්න lecturer ව choose කරන්න පුළුවන්. Right? ඒතර ඕගොල්ලන්ට මේ අපේ Infinity YouTube channel එකේ අපේ modules හැම එකේම lecturers-ලා introduction sessions කරලා තියෙනවා. Right? ඕගොල්ලෝ අපේ page එකට ගියොත් ඕගොල්ලන්ට හැම module එකේම introduction sessions බලා ගන්න පුළුවන්. Why do we do that? BL වලට සෑහෙන ළමයි ප්‍රතිශතයක් join වුණත් corporate level and strategic level continue කරන ළමයි ප්‍රමාණය ඉතාමත් අඩුයි. ඒ කියන්නේ chartered සිහිනය කරා යන ප්‍රතිශතය සෑහෙන ප්‍රමාණයක් අඩුයි. ඒක නිසා තමයි ඔයගොල්ලන්ට strong foundation එකකින් පස්සේ ඔයගොල්ලන්ට corporate level සහ strategic level වල හොඳ ආරම්භයක් ගන්න අපි students ලගේ පැත්ත බලලා අපේ lecturers ලා ඔයගොල්ලන්ට අපේ YouTube channel එකේ introduction sessions ටික mention කරලා තියෙනවා. So in our channel we support all the levels as well as we guide them to be all-rounders in businesses as well by giving them inspirational thoughts and knowledge on future skills. One thought for you. You wake up every day to get better today than yesterday. You try to reach your full potential by getting better every day. And that's the question for you.
Customer will send a document called the debit note, right? And then the supplier will send a document called the credit note, right? So keep in mind the debit note is issued by the customer, credit note is issued by the supplier. Yeah, right. Okay. So next we are going to look at books of prime entry. Now we looked at source documents. Next we are going to look at books of prime entry. Now again a business enters into numerous transactions in its day-to-day operations, right? Now all those transactions are evidenced or the proof of those transactions are source documents. That's what we learned just now. So proof of the transactions entered into by a business are called source documents. Now that is all good, but then the details about those transactions need to be formally recorded for accounting purposes. Now source documents are different documents that the business will get when it enters into transactions, but those are different documents. They are not organized, right? They are not properly recorded, right? So the first step that a business has to do is get the information from the source documents and record them for accounting purposes. So the first place that the business records all the information in the source documents for accounting purposes is called books of prime entry, right? Once source documents are created, details in them is summarized and recorded in books of prime entry. A book of prime entry is a place where a transaction is first recorded in the accounting records of a business. Now source documents give us evidence, information about the transactions entered into by a business, but that information has to be recorded for accounting purposes, and the first place, the first book that we record that information is called books of prime entry. Now you can see from the name books of prime entry, the word prime means first, right? So the first book or the first place where we record our transactions are called books of prime entry. Now even though we call them books, in today's day and age, right, these are not physical books, right? Most businesses use accounting softwares to do accounting. So even though we are going to call them books, these are sometimes not physical books, right? These are files in a computer, right? But it's easy for you to understand this concept if you think of them as physical books. So you can think of physical books where transactions are recorded, but actually now they are computer files where the transactions are recorded, right? It is a list of similar transactions in date sequential order which is then periodically totaled. So in books of prime entry, transactions are recorded in the sequential order, meaning in the order that they happen. So transactions today will be recorded first, transactions tomorrow will be recorded next, transactions that happen day after tomorrow will be recorded after that, right? So it's in the sequential order or what we call the chronological order. The totals are then recorded into ledger accounts in the general ledger as part of the double entry accounting system. Now some of you all might already be familiar with this. Once transactions are recorded in books of prime entry, they will be totaled, all of the values will be added up and then recorded in ledger accounts in the general ledger. Now we have not learned this yet, right? If you are already familiar with this, great, right? If you are not, don't worry, we will learn about ledger accounts and the general ledger in our next video, right? So from the books of prime entry, we record these transactions in ledger accounts. If we go to the first slide, you can see after transactions are recorded in books of prime entry, the next step is to record them in ledger accounts, right? There are 7 books of prime entry for different types of transactions. So depending on the type of transaction, it will be recorded in a different prime entry book. So there are altogether 7 types of books of prime entry, right? So these are the 7 types of books of prime entry. These are the 7 books, right, where our transactions are recorded for the first time. So we have the sales day book, right? And what kind of transactions do you record in the sales day book? You record credit sales. When the business sells goods in its day-to-day activities, and if those goods are sold on credit, meaning payment is not received immediately, but the customer will pay sometime in the future, that's called a credit sale. So such transactions are recorded in the sales day book. In the purchase day book, credit purchases are recorded when the business buys inventory, right, goods that the business buys with the intention of selling to customers, and when those goods are purchased on credit, meaning payment is not done immediately but promises to pay in the future, they will be recorded in purchase day book. Then sales return day book, this is when customers return goods sold on credit. Purchase return day book, return of goods bought on credit. So when the business itself wants to return goods that it bought on credit, they will be recorded in the purchase return day book. Cash book, all cash payments and receipts will be recorded in the cash book. Then the petty cash book, it will also record cash payments and receipts, but only small cash transactions. Now this is where we record all our main cash transactions. In the petty cash book, we record only small value cash transactions. Then the journal, or what we sometimes call the general journal, that's where we record all the transactions that are not recorded in any of the other books of prime entry, right? So we'll go through each of them and try to understand what they record, right? So we'll start with the sales day book. The sales day book records sales made on credit terms, right? Or what we call credit sales. Now what does that mean, right? Now when a business sells goods to a customer, normally the customer has to pay cash immediately. But sometimes businesses sell goods to customers and tell the customer, you don't have to pay me immediately, you don't have to pay me now, you can pay me sometime in the future, normally within 30 days. So that's called a credit sale, right? The business has sold goods to the customer on credit because the business is not getting money immediately but will get money in the future. So such transactions are recorded in the sales day book. Credit sales are sale of goods to a customer for which payment is not received immediately, meaning now itself, but will only be received sometime in the future. But in the future, the business will receive the payment from the customer. Credit sales result in debtors, trade receivables, right? So when we sell for cash, when we sell goods for cash, we get cash, right? When the business sells goods for cash, the business gets cash. But when the business sells on credit, or when the business enters into a credit sale, the business does not get cash immediately. It will get cash in the future. What the business gets is the right to receive cash in the future. Business doesn't get cash now, but the business has the right, the entitlement, the right to receive cash in the future. So that right to receive cash in the future from the customer is called debtors or trade receivables. The business has the right to receive cash from the customer in the future. That right is called debtors or trade receivables. Cash sales. Now, cash sales are recorded in the cash book. Now, if we are recording credit sales in the sales day book, where are we recording cash sales? Cash sales, meaning sales for which we receive money immediately, will be recorded in the cash book, right? Now, keep in mind, in the sales day book, we only record sale of goods that are part of our day-to-day business, right? So, for example, if you are a wooden furniture manufacturer, when you sell wooden furniture, right, on credit, that will be recorded in the sales day book, right? But what if the wooden furniture manufacturer sells the company car, right? The wooden furniture manufacturer has a car that is used in the company, and what if the business sells that car on credit, right? Now that will not be recorded in the sales day book because selling cars is not a part of the day-to-day operations of that business. So we only record sale of goods on credit that are part of the day-to-day business of the company or day-to-day operations of the business. So it has to be goods that we sell on a day-to-day basis. It has to be part of normal course of business. A wooden furniture manufacturer selling wooden furniture is normal part of the business. But a wooden furniture manufacturer selling an office car because they want to buy a new car is not normal course of business. That will not be recorded in the sales day book even if it is sold on credit. Right. Then this will be the format of a sales day book. So we can have a very simple format. We record the date on which the credit sale happened, the invoice number, the name of the customer and the amount, right? So the business has sold goods to Mike on January 10th worth 105 rupees, right? And then at the end of a week, at the end of a day or sometimes at the end of a month, it will all be total, right? Sometimes businesses will also have a slightly more complicated format where different sales will be analyzed, right? So now here you can't see what was sold to Mike or what was sold to Hannah, what was sold to Jack. So in this format we have the same thing, date, invoice, customer, amount, but we have two additional columns that tell what was sold to Mike. Now you can see we have sold t-shirts to Mike. Then to Hannah we have sold 50 rupees worth of t-shirts and 50 rupees worth of shoes. To Jack we have sold 25 rupees worth of shoes, right? So this value is analyzed in these two columns, what was actually sold, right? So some businesses will want to see what was actually sold, what type of goods and services were sold. Same thing, you can see if you add 155 and 75, it comes to 230, right? Then the purchase day book, right? So sales day book is when we sell on credit, purchase day book is when we buy on credit. So when we want to buy raw materials or when we want to buy finished goods from a supplier to sell to our customers, right? We can pay for that immediately or we can promise the supplier to pay sometime in the future. That's called a credit purchase. We have purchased but we have not paid for it immediately. We have promised to pay for it in the future. That's called a credit purchase. Now again, in the purchase day book, we can only record goods that we have purchased with the intention of selling to customers or the goods that we have purchased with the intention of using it in our manufacturing process to come up with a finished product that we will sell to the customer. Now if you are in the business of buying and selling, let's say rice, so if you are buying and selling rice, then when you buy rice with the intention of selling it back to the customer, that's a purchase, right? Or sometimes it can be, now in the wooden furniture manufacturer, you buy wood not with the intention of selling wood to the customer, but with the intention of using the wood in the manufacturing process that will make furnitures and then sell those furnitures to the customers. So anyway, when you bought the wood, right, you're buying it with the intention of eventually selling it to the customer after the manufacturing process, right? So again, now if the wooden furniture manufacturer buys a car on credit, right? If the wooden furniture manufacturer buys a car to be used for administrative work on credit, that will not be recorded in the purchase day book because the wooden furniture manufacturer doesn't buy cars with the intention of selling it to customers. That's not their business. So in the purchase day book, we only record purchase of goods on credit in our normal course of business, what the business normally does, right? In accounting, purchasers refer to purchase of goods or what we call inventory with the aim of reselling in the ordinary course of business. So reselling means either directly buy and sell or buy then process, meaning take it through a manufacturing process and then sell the finished product. Either way, our intention should be to sell it to the customer. Credit purchasers are purchasers of goods for which payment is not made immediately but will be paid sometime in the future. Credit purchases result in creditors' trade payables. Now, with a credit purchase, we don't have to pay cash immediately, but we create that obligation. We have that responsibility now to pay to the supplier in the future. So that obligation to pay to the supplier in the future is called creditors or trade payables. Cash purchases, on the other hand, are recorded in the cash book. So when we buy goods by paying cash immediately, that will not be recorded in the purchase day book. It will be recorded in the cash book because there's a cash outflow, there's a cash payment, right? Remember, this is on credit, right? We have not made the payment immediately. We promised to pay in the future, right? So the format is very simple. Date, the supplier's invoice number, right? You can see here we record the invoice number we received from the supplier, and they can have different numbers. It's not a particular order. Whereas here in the sales day book, the invoice numbers have a particular order, right? Now here there is no order because these are invoice numbers in the invoices received from different suppliers, right? So these are the suppliers, these are the amounts that we have to pay them. Invoice numbers are not in a particular order as these are invoice numbers of the suppliers. Therefore, invoice number column is sometimes omitted. So sometimes even the supplier invoice number is removed from this purchase day book. Then the sales return day book. So we already learned about debit notes and credit notes. Sometimes when a business sells goods to a customer, the customer can return those goods. So such situations are called sales returns, right? The business has sold, business has done a sale, but after some time that sale can be returned, those goods can be returned. That's called a sales return. Now in our sales return day book, we record all return of goods by customers which were sold on credit, right? So in the sales return day book, we only record return of goods by customers which were sold to them on credit initially. So we have sold goods to the customer on credit first, and then that customer returns some of those goods back to us. So it has to be a return of goods that were initially sold on credit. If we sold our goods on cash to the customer initially and then eventually the customer returns the goods to us, then that will not be recorded in the sales return day book because here we are only recording return of goods that were sold on credit, right? Therefore, sales return day book is the book of prime entry for credit notes issued. So when there's a sales return, we know the supplier or the business will have to issue a credit note. Where a business has very few sales returns, it may record a credit note as a negative entry in the sales day book. So if there are only very few sales returns, the business might not have a separate sales return day book, but record the credit notes as a negative entry in the sales day book itself. So instead of maintaining a separate sales return day book, the business can record the credit notes as negative values in the sales day book itself, but that is not advised. Normally the business should have a separate prime entry book for sales returns. So the format is simple: date, the credit note number, the number issued by the business, customer and the goods. Now Mike is returning 3 shoes. What's the value of those goods? 105. Okay, right. So again, keep in mind in the sales return day book, we are recording return of goods by customers which were sold to them on credit, right? Then purchase return day book. So the same way customers can return goods back to us, we can also return goods that we bought back to our supplier. Yes. So that's called a purchase return. What we purchased, we are returning. That's a purchase return. All return of goods to suppliers which were bought on credit. So here also in the purchase return day book, we are only recording return of goods that were bought on credit, right? So we have bought goods from a supplier on credit, and then later on we return them back to the suppliers. A transaction like that can be recorded in the purchase return day book. If we initially bought goods on cash and then later return them back to the supplier, that is not recorded here because the initial transaction was not on credit. It has to be on credit, right? It has to be goods that we bought on credit that we return to record it in the purchase return day book, right? So if we return goods that we bought for cash, right? If we bought the goods for cash initially and then subsequently we return them to the suppliers, that will be recorded in the cash book, right? Because along with the goods, right, we should also get the cash from the supplier here. So we have already paid them cash. When we return the goods back to the supplier has to give us the cash back. So that's why we record in the cash book because we are receiving cash when we return the goods. Right. So here we are recording only the returns that were initially bought on credit. Therefore, purchase returns day book is the book of prime entry for debit notes issued. Now, we know when we return goods, we have to issue a debit note, right? When we return goods, we issue a debit note, or you can think of it as credit notes received. So, we are the ones who issue the debit note, but at the same time, we get a credit note from the supplier. So, you can think of the purchase return day book as the prime entry book where you record debit notes that you have issued or the credit notes that you received. Now, here in the sales return day book, we record credit notes issued, the credit notes issued by the business. Here we are recording credit notes received by the business, or simply debit notes. Once again, a business with very few purchase returns may record a credit note received as a negative entry in the purchase day book, right? So again, if there are only very few purchase returns, instead of maintaining a separate purchase return day book, the business can record the purchase return as a negative entry in the purchase day book itself, right? So the format is again simple: date, debit note, supplier and the goods, and the amount. So we are returning 3 shoes to Mike. The value of them is 105, right? Then we have the cash book, the 5th prime entry book. So we covered the sales day book, purchase day book, sales return day book, purchase return day book. 5th one, the cash book. So this is the prime entry book where we record all our cash payments, that means cash outflows, and cash receipts, meaning cash inflows. Now here normally we record all cash payments done in either notes and coins or using checks and bank transfers. So we normally don't maintain a separate account just for notes and coins transactions and another one for bank related transactions. Normally both are recorded in one, right? The cash book is the book of prime entry for all cash receipts and payments. Receipts is when we receive cash. That is, it records all transactions that go through the bank account. This could be money received or paid in notes and coins. So when we pay in notes and coins or when we receive notes and coins, that will be recorded in the cash book. At the same time, there are also receipts and payments made directly to the bank, like bank transfers. Sometimes we don't pay in notes and coins, we issue checks or we do a direct bank transfer to a supplier. So those will also be recorded in the cash book. Like bank transfers, standing orders, direct debits and bank interest and charges. Many businesses maintain 2 cash books, one for receipts and other for payments, right? So normally businesses will have 2 cash books, one just to record cash inflows or cash receipts and the other one to record cash payments or cash outflows, right? So this is the format for a cash book, the receipt part, right? So in this cash book, we are only recording cash inflows, money received by the business. So we have the date, the narrative, right? A small explanation of what the cash is for. Then the total, the amount of money received, and then this is what we call the analysis, right? We can analyze for what we received the cash, right? So you can see at the beginning we have the balance brought down, right, or what we call the balance brought forward. This is the cash we have at the beginning of the month of September. So the beginning of month of September we have 250,000 rupees. It's in thousands, so 250,000 rupees. Then we have done a cash sale. We have sold goods to a customer for cash. We received cash immediately. How much? 8,000. So we analyze it. We have 3 columns here. We put it under cash sales column. Then we have received money from accounts receivable called Harin, from a debtor, a customer to whom we sold goods on credit previously has paid that amount back, 38,000. So we have sold goods to a customer called Harin previously and that customer is now paying us the money that he has to pay us, 38,000, and that we analyze under accounts receivable. So this is a good way to kind of identify from where we receive this total amount of money. Then accounts receivable Bibul, another debtor who has paid us money. Accounts receivable Sanya, again another customer who has paid us money. Loan, we have taken a loan from Lendinger, right? We have taken a loan, so 1,500 we received cash, that goes under other. Cash sale again, then sale of non-current asset. So a non-current asset can be something like a machine. We have sold one of our machines and we have received 200, right? So that's also under other. So when you add up these columns, you can see we have 2,000, 2,324. All three together adds up to 2,397, or you can simply add them like this, right? 2,397. When you add these two, of course, when you add these three, of course, it doesn't add up to 2,397 because this opening balance is not here, right? So when you add these three and the 250, you get this 2,397, right? Then the cash book, the payment side. This is where we record all our cash payments, right? Right. So on 1st September, we have made a payment to one of our creditors or to one of our accounts payables, a supplier from whom we have bought goods sometime before and to whom we are now making a payment. So we are paying 120,000 to KW Supplies. Then accounts payable and other supplier. Now our telephone bill we have paid, so that goes under other. Again, this is the analysis. Then for gas we have paid 280. For petty cash, to pay for small expenses, we have given 100. We have bought a machine for 1,500 and yeah. So again, now here you can add these columns, right? And we will get 430, 100, 108, 1,820. So let's add them. 1,820, 100 and 430. So what do we have? We have 5, 0, 12, 13, 2, 3, 5, 0. 2, 3, 5, 0. Right. But what is this value here? What is this value here? Now, during the month of September, or on the first day of September, right, we had 2,397, right? We had an opening balance and then we also received these amounts of money. So altogether we have 2,397, right? So that's the amount of money we have, 2,397. Then during the same day, we have made payments for 2,350. So how much money do we have at the end of the day? How much money do we have at the end of the day? We have 47 left at the end of the day. We received this much money, right? Received and the opening balance, and we paid this much money on the 1st of September. So we are left with 47. This is that 47. Balance carried down. This is what we are going to take forward to the next day, right? So what you have to do is take the receipt column total and put it here and add them together, and if there's a shortage, the balance amount goes as the balance carried down. So when you add these three or these items, just these items, it comes to 2,350. And during the year, we received this much money, right? We received this much money, but we also had this at the beginning of the year. We had this much money at the beginning of the year. So altogether, 2,397 at the end of the day. So this is what we paid. So what we are left with is 47, right? Now, I'm assuming this is all the transactions that happened on 1st of September, right? Then we have the petty cash book. We learned the cash book. Now we are looking at the petty cash book, right? So the petty cash book is also a cash book, right? So it records cash payments and cash receipts, but it only records cash payments and receipts that are small in value, right? Now, if you record all cash payments and receipts, even the small cash payments and receipts, for example, the business can spend money to buy refreshments for a client, to buy some short eats for a client, or the business can pay an employee the taxi fee. The business can pay the office cleaner a very small amount of money. So those are very small value transactions. If all those small transactions are also recorded in our cash book, right, our cash book can get too complicated. It will have too many transactions and it will be difficult to find out the most important transactions. So instead what we do is we record the small transactions in a separate book of prime entry called the petty cash book. Petty means small, right? So the petty cash book is the book of prime entry for small cash receipts and payments. Most businesses keep a small amount of cash on the premises, meaning at the office, to make occasional small payments in cash. For example, staff refreshments, to buy some short eats, to buy some cakes for staff, postage stamps, right, to buy stamps, to pay the office cleaner, taxi fares, etc. This is often called the cash float or the petty cash account. So normally what the business will do is they will keep some money aside at the office in notes and coins to pay for all these petty cash expenses. The cash float can also include occasional small receipts. Now sometimes we also get some small amounts of money. We discussed about small cash payments, but there can also be small receipts. For example, if we let a visitor or a client use our telephone, we can charge the client or the visitor a fee for using the telephone. So cash paid by a visitor to make a phone call, that will be a very small amount. So if someone uses the office telephone, we can charge him, let's say 100 rupees. That's a very small amount of money, right? Okay, so the petty cash book records both cash payments as well as cash receipts. Right, so now the petty cash book works according to a particular system called the impressed system, right? The impressed system. Many business entities use an impressed system to account for and control petty cash transactions and balances, right? So how does this impressed system work? Now in an impressed system, what happens is at the beginning of a month, normally at the beginning of a month, right, specific amount of money will be withdrawn from the main bank account of the business and given to the petty cashier. So the main cashier, the person in charge of the main cash book, will withdraw a specific amount of money from the main bank account and give it to the petty cashier and tell the petty cashier, okay, let's say here's 1,000 rupees for you to manage all your petty cash expenses for this month, right? So that specific amount of money, that fixed amount of money is what we call the petty cash float. A specific amount of money is withdrawn from the bank account, which is referred to as a petty cash float. So that amount of money is what we call the petty cash float of the impressed amount. The float is then used to pay for various small expenses. So the petty cashier, person in charge of small expenses, will use that money to pay for small expenses during that month, right? And every time the petty cashier gives money to pay for small expenses, the petty cashier will create a payment voucher, that's a source document. And every time the petty cashier receives a small amount of money, the petty cashier will again create a receipt, right? So all payments and receipts of money must be evidenced, right, by an expense voucher or a receipt, right? So every time petty cash is used to pay for something or money is received by the petty cashier, he will create an expense voucher or a receipt. At any point in time, the cash balance, the amount of cash that the petty cashier has, together with the value of the expense vouchers and the receipts, should agree to the total of the float. So if the petty cashier received 1,000, right, at any point during the month, the amount of cash the petty cashier now has left, right, let's say the petty cashier has 300 cash left, right, that amount of cash plus the value of the vouchers, meaning the value of the payments he did, let's say 750, right, 750 minus any amount of cash he received, right, the value of the receipt. So because every time the petty cashier receives money, a receipt will be issued with that amount. So the value of the receipt, let's say 50, should be equal to this impressed amount. So the petty cashier received 1,000, use that 1,000 to pay for expenses worth 750, right, and also received 50 from an outside party, a small amount of money, right. That means petty cashier will have 300 rupees left with him at this particular point, right? So 300 plus 750, that's 1050, minus the 50 gives us 1000. So this should always be true, right? At any point, the amount of money the petty cashier has plus the value of the vouchers he has issued minus the value of the receipts should be equal to this impressed amount or the specific amount of money given to him at the beginning of the month, right? Then at the end of the month, what will happen is, at the end of the month, the petty cashier will be given an amount of money equal to the value of the vouchers and the value of receipts. So at the end of the month, the petty cashier will be given again a sum of money by the main cashier equal to this value of the vouchers minus the value of the receipts, right? So let's say this is the situation at the end of the month. Now at the end of the month, the petty cashier has 300. Then what the main cashier does is, the main cashier gives him an amount of money equal to this amount here, 750 minus 50, that is 700. So the main cashier gives the petty cashier 700 at the end of the month, right? Periodically, the cash balance will be replenished. This cash balance will be replenished, meaning topped up to the predetermined amount. Now, when the main cashier gives 700 to the petty cashier already has 300, receives 700 from the main cashier. So at the end of the month, the petty cashier will again have 1000, that fixed amount of money will be replenished to the predetermined amount, or what we call the float, to reimburse amounts paid out. The amount of the top up, the amount given by the main cashier to the petty cashier, will be the total of the voucher payments, right, this value, minus the receipts since the previous top up. Since the beginning of the month, the value of the vouchers minus the value of the receipts will be the value of the top up, or the money given by the main cashier to the petty cashier at the end of the month. So this system is called the impressed system, right? Now let's just look at an example that will help you understand this better. So DEF operates an impressed system for petty cash. During February 2009, the following petty cash transactions took place, right? So these are a couple of petty cash transactions that took place in the month of February, right? So the petty cashier has paid 1200 for stamps, milk 2500, taxi fare 1500, stamps 500, then has received 800 for photocopying, stationery 750. Now remember, this is a receipt, right? The amount remaining in petty cash at the end of the month was 9350. So at the end of the month, the petty cashier has 9350. What is the impressed amount? What is the value of the float, right? So it's very easy. All we have to do is first find out the value of the payments, right? So the value of the payments is 1200, 2500, 1500, 500 plus 750. When you add them, we get 6450. And there's one receipt, 800, right? And we know the impressed amount is equal to the cash held in petty cash, the amount of cash the petty cashier has, plus the value of the vouchers minus the value of the receipts. So then we have 9350. The petty cashier currently has 9350, right? That amount plus the value of the payments minus the value of the receipt is equal to 15,000. That is the impressed amount. That's the fixed amount of money. So then at the end of the month, the petty cashier will get this amount back, 6450 minus the 800, right? Minus the 800. So the petty cashier will receive 5650 at the end of the month, right? The impressed amount is 15,000. So this amount plus the 9350 he already has is equal to the 15,000 impressed amount, right? Then the last book of prime entry, the journal or the general journal. So this is where we record all other transactions that are not recorded in any of the other books of prime entry. If you have a transaction that you cannot record in any of the other 6 books of prime entry, you will record it in the journal or the general journal. The journal is the prime entry book for transactions which are not recorded in any of the other books of prime entry. These are normally non-routine transactions. So the transactions we record in the journal are normally non-routine transactions, meaning transactions that don't happen every day. Examples of transactions recorded in the journal include purchase and sale of non-current assets on credit. Now, if you buy a non-current asset like a machine, it's not inventory because we are buying it with the intention of using it in the business for a long period of time. So, if you buy a non-current asset like a machine on credit, right, you cannot record in the purchase day book because it's not inventory. At the same time, you cannot record in the cash book because you have bought it on credit. You have not paid cash for it. So, then you have to record it in the journal. Then recording annual depreciation charge. Some of you might already be familiar for non-current assets like machine, which we call property, plant and equipment. We have to charge depreciation. So, that will be recorded in the journal. Write-off of bad debts. If some of our debtors, accounts, receivables refuse to pay the money that they have to pay us, they have to be written off or they have to be cancelled. That will also be recorded in the journal. Provision for doubtful debts. Sometimes for our debtors, we create a provision knowing that some of them will not be able to pay us back the money. That will also be recorded in provision for that will also be recorded in the journal. Then if we find out that we have done some mistakes when recording transactions, we will have to pass a double entry to correct those mistakes. That will also be recorded in the journal. Right, so now don't worry about this. We will learn each of these transactions in detail as we progress through this subject. A narrative explanation must accompany each journal entry. What does that mean? Now this is the format of the general journal. So it's very simple. We have the date, then we have the details. Now in the details, what we do is we record the names of the two ledger accounts involved in the transaction. Now we haven't learned ledger accounts yet, right? But if you're already familiar with it, you know what I'm talking about. If not, keep in mind, we are just recording the two accounts, the two ledger accounts that are involved in the transaction and the debit amount and the credit amount. And once we record that, we also have to give a small narration, a small explanation about the transaction. So what is this transaction? We are recording the purchase of a new non-current asset on credit. So we have bought a non-current asset, maybe a machine on credit, and that's what we are recording through this entry. So this small explanation is called the narration. Right. So that brings us to the end of books of prime entry. Now in books of prime entry, we learn 7 books, right? Sales day book, purchase day book, sales return day book, purchase return day book, cash book, petty cash book, the journal or the general journal, right? And then before that, we also learned the source documents, right? So you have to completely understand source documents and books of prime entry to understand the next step, which is ledger accounts, right? So our next video is going to be on ledger accounts. Thank you for watching.